Hi everybody. So this is Venzen. I'm here to talk to you today about trading method, the importance of having a trading method. What is a trading method and why what most people are doing in the market is not a method at all. So first of all, to have the discussion about method. Right. If you're gonna do anything and call it a method, if you're gonna have any kind of structure or checklist and call it a method, it means that it must be an identical process. Right? Variation is allowed, but you need certain steps in a certain order in order to be methodical. Right. So what you want to do with your trading is to be methodical. In other words, uh, if your indicators are giving you a signal, then you must have a set of prescribed steps that you're going to take to methodically get you into the trade, to size your position, in other words, to determine your risk, and then to get you out of the trade. That is a trading method. Right. Your size of your position, your risk stop point, those kind of things, the amount of leverage you're going to use, how much you place on a bet in the market, that becomes your money management strategy. That's informed from a money management system. That I'll cover in a different video. Here I'm merely talking about the mechanical steps of getting a signal in the market, acting on it in a predetermined mechanistic way, opening your position, and then closing your position. Right. So, in order to illustrate this to you, I'm gonna go to the most simplest indicator. There are probably simpler ones. The one that I consider very simple and effective is a straight stochastic indicator, a stochastic of price. And you've got your K and your D lines on there, and the one acts as your stochastic and the other is your signaling line. So when your stochastic crosses your signal line, that's that's a signal. That means you've got to now take some action. Right? And it's surprisingly good. Simple and effective. I'm going to show it to you. Before we get into this stochastic, I just want to talk about what is not a trading method. Right, what you find a lot of guys are doing in the market, I see them all day long on Twitter and TradingView and in some groups I belong to. They're going to start jumping up and down and saying, "Oh, this is an accumulation zone. Now it's time to buy. It's time to buy the dip." That's not a trading method. That is some tea leaf reading. That's some conjecture. That is not what is the person basing that on? Is there an indicator for that? There isn't. They're saying, "Oh, this is becoming overbought now." When it's going up. Yeah, it's hitting previous support and resistance. This is, there's signs that the market is overheated. What signs? What, how do you quantify that? What mathematical, scientific indicator are you using to tell you that, right? So I'm not talking about people's feelings, when they get the feels now. I'm not talking about that. I'm not talking about people's gut instinct. I mean no disrespect, but your gut instinct is a female energy. We've all got that. Some to a greater extent, some to a lesser. But as a person trading the market, you don't want to be using no female magic. You're accessing your feelings and your gut feelings. You're always going to be wrong. The market is not a place for female instincts, for female feelings and intuitions. This is perhaps the reason why there's no legendary female trader, right? You can argue with me, we all created equal and a blank slate and all of that. I'm with Jordan Peterson, man. Psychologically speaking, scientifically speaking, there are major differences between a male and female gender. And and the two genders have got different qualities and different strengths and weaknesses. The energy that is going to make you survive and trade profitably in the market is male energy, because this is a mathematical, mechanistic, rational exercise, right? So in terms of all the top and bottom calling and people closing their position because, ooh, now there's a divergence in RSI. That is not a method. Divergence in RSI, tone keeps telling you. People are like, ooh, there's a divergence. Yeah, so what? It can diverge until the cows come home. Divergence is not a signal to do anything. It's a warning sign. It's an indication of a lack of momentum, but it's not yet the signal. The signal is very crisp and clean and mathematical and repeatable. You'll see it in the chart. Repeated exactly many times as far back as your time frame goes. Right. That's the one aspect. I'm talking about method. I'm talking about a rational, technical, repeatable method that's indicated with a signal, right? That your decision is based on a signal. So in terms of all of this non-trading method stuff, the female intuitions and the need for drama and the non-technical decisions that traders make. I want to ask you a question now. I want to ask you a question. Consider it carefully, right? Because if you can grasp this, your trading will change. Your trading will change permanently. And not only your trading, your entire life will change. But you got to get this, right? When you go to the casino, there's a lady that handles the chips. She's called a croupier, and she's going to spin the roulette wheel, right? And she's going to spin it, and then she's going to throw a little ball in it, rotating counterclockwise, and then she's going to say, when the ball starts slowing down, she's going to say, no more bets. And after that, you can't place bets on the roulette table. You can't say, oh, I think it's going to be red, or you think it's going to be number 11, or none of that. You can't do it. The bets are off. When we go to the market and we go to the troll boxes and the social media, we see that there's in the absence of any technical signal, in the absence of anything significant in the chart, you get some guy tweeting saying that he's all in short now. And he shows the chart with some lines on there and the arrow pointing at something that I don't know what it is. You don't know either. It means something to him, but it's not a verifiable, technical, repeatable signal. He's short now. Why is he short? He's got some feeling from somewhere, right? And this decision of his, the market's not yet going down. It's still going up, right? It's still going up, but he's gone short now. This is a casino mentality. That's like pretending to yourself that somebody called no more bets. But in the market, there is no more bets call. There is no such call. You can bet any time that you want, right? So this is the analogy I always use. Think of the market as just life outside. Think of it as the weather. We don't know what's going to happen with the weather. It might rain, it might not rain today. I'm in monsoon season. The chance that it rains is like 60%. But say I'm thinking it's going to rain today, right? And as it is, today it hasn't rained, right? It might not rain. It might be that one day where it doesn't rain during monsoon season, and there are often 5 or 6 days like that. I'm saying I'm going to bet on rain, right? So that's like the guy going short in the market while price is going up. It's sunshiny, there are no clouds. I'm saying I'm betting on rain because the weather report said 60% chance of rain. But there's no sign of rain. And now I bet. Why am I doing that? In the market, you can wait for the clouds to gather. You don't even have to place your bet then. You can wait for the thunder and the lightning and the wind with the smell of rain. You can wait for that. You still don't have to place your bet. And then you can wait for the rain to start splattering on your head and place your bet, because nobody called no more bets. You can actually wait for it to start raining and then place your bet. Do you get that? Do you get what I just told you? Right? I say this to people and they're like, oh, that's a great analogy. Yeah, it's a great analogy because you're thinking that somebody's called no bets in the market. There is no more bets called. You can bet anytime you want. So let me show you how to do that. I'm going to go to a screen share here, and I'm looking here at the Bitcoin price chart. This happens to be the BitMEX perpetual swaps during sort of the end of 2019. Remember the drop through below 6,000 there, down to a December low, and then there was an upward reaction sideways for a few months, and then we started this gradual advance that we're still in. So looking at the latter stages of the advance, or even for the advance from here onwards, this is a one-day chart. This is a stochastic standard setting, default setting in TradingView. Over here you see that price shoots up through, the stochastic, the blue line shoots up through its signal line. Right, so say you take the decision to buy. Then you got to sell, you got to close your position when the stochastic goes back below its signal line. And if you follow these, you will see that you make fairly good trading decisions each time. For instance, each one of these signals are true, starting from there. Over here, stochastic advances above its orange signal line. You buy. You get out right at the top of that candle with your stochastic. Then the market goes sideways, right? Okay, you buy there. You get out at some kind of high up there. You buy over here. You get out as price starts plummeting down. When you buy here, you get into some long ass advance. You get out when price corrects over there. Then you're buying and closing position, buying and closing position, and each time the stochastic gives you the right signal, right? It's not fooling you around. Can you see that? Try it for yourself. You can try any time frame, 1 week, 1 month, 1 day, 1 minute. It's going to be true. That's from a stochastic. So we are saying that the stochastic is a good indicator for a trading method based on the fact that the stochastic crosses its signal line, and when it crosses its signal line again, you close your position. And I just illustrated to you that it's good, it's reliable and true. However, let me also show you where it's not reliable. When price is advancing near the top of this formation, where we're currently still just around 8,000, you see that it tells you to buy over here. Price rises about $200 and then drops. If you're quick enough to get out, if that stochastic signal was quick enough, you might come out break even, because that's really fast, that price action. When you buy again down here, right, are you sure, because this is a one-day chart, by the time that you buy, by the time you see the signal, price is already topped out and is busy coming down. Probably this will be a losing trade for you. The next one is better, because you get a stochastic buy signal as price is consolidating, as price is kind of slowly rising, and then it tops out near the top. So this would have been a winning trade at the top right hand corner. Over here we're back to the situation where you're getting in on a candle that's busy topping out and is probably a losing trade for you, if not break even. If not break even, it's probably going to be a losing trade. So we find that the stochastic is not very good for us when price is not busy trending. If we look at the left hand side of the chart, there was a downtrend and the stochastic signals are good. It's telling you to sell up there. You remain in trend for $1,000 before the stochastic tells you to close at a correction. Thank you very much, stochastic. Another sell signal, which is over another $1,000. You close. Thank you, stochastic. But then you get a situation where price is starting to to move higher during the stochastic close signals, there's a stochastic pushing through its signal line to the upside. That's actually a buying opportunity, right? But you don't know that. You're just like, well, I'm waiting for the downtrend to continue, because the stochastic was really good during the downtrend. But when the trend reverses, the stochastic cannot indicate that for you. You need something else to know the direction of trend. So for instance, here you're like, oh, it went up. So on the next stochastic buy signal, I'm going to go up with the stochastic. Now you buy, it's actually a fake out signal. You buy over there, okay, it's fair, but you got a winning trade right there from the stochastic, but you just had a losing trade. Here you've got another series of losing trades because the trend is slightly down. So now you're like, is it up or is it down? What do I believe? The buy signals or the sell signals? The stochastic cannot tell you the direction of trend. It can just give you buy and sell signals, but you've got to know what the direction of trend is. You've got to know that from something else. So how do you know that? What I developed during the past 5 years of trading Bitcoin was a set of indicators. It's not even a set of indicators. It's the same indicators, one indicator that I repeat on the chart a few times in moving averages. And this group of moving averages will indicate for you the direction of trend. You're familiar with Tyler's Consensio system, which is the same thing as I'm talking about, but Tyler and I developed it independently. Me and Tyler use different periods for our moving averages. Tone has got some moving averages on his chart. He doesn't really use them than to see crossovers and support, right? But he never talks about trend in relation to the in relation to the moving average indicators. He's using the sequential system, which amounts to the same thing. It's a very good system for getting signals, right? I wouldn't trade it the way that Tone trades it. I trade my own method. My subscribers trade according to my method. Some combine the two, and they also report that there is mostly correlation between the moving averages and Tone's indicator. But what I would like to show you, you come to me, you can come to my website and subscribe month to month, or even better, you come to me for a workshop for 5 days in this resort in Thailand, in the south, in a national park, in a traditional setting with traditional Thai houses, Thai food cooked for you on location. You go sit on the beach with me every morning and meditate, do some exercise, and then we get to work, and I show you over 5 days how the market behaves. I show you a trading method, I show you a money management system, I show you how to control your risk, and then when you leave here, you will have 100% certainty about what you've got to do in the market to remain on your purpose and to achieve your goal of financial independence, which is why you're trading in the first place, right? So don't waste your time in the market without a trading method. Don't waste your time in the market with gut feelings and emotions. You're always going to be wrong. Come to me, let me show you a method. Let me orientate your mind towards profitable trading. I'll show you how to make your losses small and how to let your winners run, because you're now going to be trading the trend and not these consolidations. You're going to know when it's a consolidation, you're going to know when it's a trend. And when it's a trend, the indicator that I teach you will show you